What's up, good people? How you doing? Where y'all been? Hey, if you're new to the page, go ahead, hit the like, subscribe, and the notification bell, and come join the family. Hey, we make money whether the market is going up or whether it's going down. We limit our risk. We don't just want hot plays, which I give you a lot of hot plays, but we want to know how to make money long term. So come join the family known as Stock Up. I'm going to say this right now. The top link below will be to Webull, which they have a brand new promotion that started today. Download the app, deposit 1 penny. Let's see what they're talking about here.
Welcome to what promises to be a very... Join us. We're a few minutes away, as you probably know, from the release of the Fed's statement on interest rates. The central bank's...
Okay, they scared me. I saw that breaking news come in. I want to be live with it, okay? And so we're going to see what's going on. Let's look at the markets right now. As you guys can see now, the Dow is down. Everything is down pre-market. Let's add the S&P. Let's add the NASDAQ. The market is scared of the Fed. Scared. Like jittery scared. Like scared. And hey, blessings, everybody. Oh, there goes my man with the cowboy hat. How you doing? How you doing? Hey, how you guys doing? Hey, how you guys doing? All right. So we're going to see what's going to happen, y'all. We're going to see what's going to happen. As you guys see, it's down. But we're going to see what's going to happen today. All of those positions that I was in today, I am now out because of my stop losses. They all triggered. So what you saw is where I cashed out because I raised my stop losses on every one. So I am no longer in an active play, and I'm cool with that because I'm about limiting risk. I'm about grabbing my money and running, just like that commercial. Start the car. So I got my bag of money and I'm running. Just think about that. We're taking our money back, good people. That's what we're doing. We're getting our money back. Not just our money, the money they took from our parents, our grandparents. They took our 401ks with all of this, manipulation and putting out FUD when things are low, and then they force it lower, and then you tap out and sell, and then they come and dump right back in. As a matter of fact, there's something I wanted to show you guys. Hey, good morning, everybody. Well, good afternoon. I'm still saying morning. There's something I wanted to show you guys. There is something I want to show you guys where the big money is. Let's see if I can pull this up. I texted it to myself. Big money is going into bonds. Let's see if I can pull that up. I'm going to airdrop it so you guys may hear something. I'm going to airdrop it. Big money is going into bonds, right? What does that mean, Larry? That means that they are fearful of what could happen. Hedge funds, right? And so I have to continue to be cautious and let's see here and, keep you guys cautious. There is a way to make money. I'm dropping it to the wrong computer. There is a way to make money. And let me cut this off. Let's see here. Hopefully that didn't mess up my live. There we go. We're still going. Yep. There is a way to, what you say, Stockmo nailed it. Yep. Stockmo and myself. This is what happens every time, right? But let's see if it bounces green just before he talks, which it has the last couple of times. So Stockmo nailed it. I didn't see that. That's my man. And that's why I say, hey, let's continue. You know what? Let me just go to it and we'll come back.
prices, which are starting to climb again. And because we've seen so much resilience within the labor market, look at that JOLTS number today, we don't think it really gives the Fed much wiggle room in order to become accommodative, because the Fed is very afraid of inflation coming back, which means that they've continued to say there are greater risks of under tightening versus over tightening.
Jim, I'm going to save the first word after the decision for you. We've got about 9 seconds left before we can go to Steve Leisman. The Dow right now down 300 points, and let's go to Steve with the Fed's decision.
Federal Reserve raising by 25 basis points to a new range of 4.5 to 4.75. This is the 8th straight hike by the Federal Reserve since March, up by a quarter to 4.5 to 4.75. The Federal Reserve sees ongoing increases as appropriate. So that phrase that some thought might come out remains in. The Fed is still en route to a level it calls a sufficiently restrictive level of the funds rate. One little bit of dovish commentary here says inflation has eased somewhat. However, it says it still remains elevated. The Fed is signaling a new focus on the extent of rate increases and not necessarily the pace. So it says in determining what it now says is the extent of increases. That word had been pace previously. So it's not thinking about it going up by 25. It's thinking about how far it goes at this point. On the economy, it sees modest growth in spending and production. It says job gains have been robust. The unemployment rate is low. All language from the prior statement. The decision was unanimous, with the 4 new voters replacing the prior 4 who were out there. So, Kelly, back to you. Up a quarter. Still thinking about ongoing increases, still heading to a sufficiently restrictive level.
Any dissent, Steve? That's a pretty big deal that they left in
unanimous.
The word ongoing. Wow.
Yeah, they left in ongoing means they have more to go. I guess that's pretty clear. And they're not backing off anyway, this idea of going to what they call a sufficiently restrictive level, which tells you that they don't feel like they're there yet.
Right. And as we can imagine, Steve, thank you. We'll come back to you in just a moment. Markets are reacting about as poorly as you might expect. Although we were all saying all week long we're probably bracing for a hawkish surprise. You can see stocks taking a leg lower and bond yields perking up a bit. Let's bring back our panel along with Bob Bassani and Rick Santelli. Rick, I'll turn to you first. What are your thoughts?
Well, you know, we do see 2-year notes spike, but they're already coming back down. We saw 10 spike. They're coming back down a bit. And the Dow Jones Industrial Average drop, but it's coming back. There's a lot of mean reversion going on there. Listen, after listening to Steve's highlights of what the Fed has in the statement, it seems to me that the guardians of the U.S. economy, which is the Federal Reserve, aren't going to be happy till they give birth to a recession. We've seen economic contractions like PMIs, and I see sections of the economy slowing, but we have a strong labor market, and labor is a pain that the Fed doesn't want to occur. They want to induce weak labor pains, and to do that, they're going to keep higher for longer. So no matter how you slice this, I do believe that the markets are going to continue to look beyond the rhetoric, look beyond trying to give birth to a recession and the cleansing breath it may need for pricing after we've gone through COVID and all those issues. But in the end, it certainly seems to me like all the momentum in pricing has reversed, and the only thing left is for the Fed not to blink too early, because there is no good reason in their minds, in my opinion, that they should ease back. They should keep rates up. But I certainly don't believe that there's going to be a March increase. My personal feeling is that this is going to be it for now.
I don't know. They just said ongoing rate increases will still be. By the way, the Dow's down about 400 points right now. David Kelly, I should say Jim, actually, we promised to turn to you. What are your kind of knee-jerk reactions here? What jumps out to you?
Yeah, so look, I think that another hike in March is probably on order. I think it's going to be very important to hear what they say in the press conference, in the sense that wage inflation, the tightness in the labor market, I think is what's concerning them.
I'll come back. Of course, the Fed is going to go live, and I'll come back to you guys. As you can see, the Dow is tanking even more. It started to fight back up, and then it has to process all of this data. And so for those of you to say, hey, what does this mean? We have to process this. Look at the Dow. It literally, you have to go through what the Fed says line by line, because sometimes the market reacts one way and then it turns around and goes the other way. Pretty much the Fed has been consistent. He's consistently said this is what he's going to do, and he's doing exactly what he said it's going to do. So that's why the market was like, well, he kind of said it. And then as you see the Dow go down, and then it's like, wait a minute, but this is still bad. I mean, as the Dow goes up, and then the Dow goes, wait a minute, this is still bad though. Then it starts to tick back down. As you can see, it's around 370, and it was down 400 a while ago. And this is the day that is going to be the day. This is going to be the roller coaster. Unfortunately, when the Fed begins to speak, the biggest damage to the stock market is going to be the people, the good people that's going to be asking the questions, right? So if someone asks a question about, hey, do you see any, brighter paths or green pastures? And the Fed answers that in a positive way, you will see the market start to come up. But then you always have this gotcha woman or guy that will ask, how much are you going to hammer the market? Like, what happens if you think inflation is going to come back? What will you do? And then he's got to answer something that sounds hawkish. So then you'll see the market go down. And so that's why I hate the dog and pony show after the Fed comes out with his decision. Just come out with your decision, go sit down and shut up. Like mama used to tell you in church when you was loud. Go sit down and shut up. That's why I put on my thumbnail, me going like this, because I don't want to hear what you got to say right now. You already said it. Now you're going to talk the market down further? Come on, Powell, Uncle P. Come on, man. You inflicting pain. So that's my rant, y'all. It's my rant. But that's like, hey, we all got money in the market. Let's go. All right. So where we at? Soon as I see him come in, I'm going right to him, and we're going to keep our eye on everything. Man, y'all know I'm telling y'all the truth. Y'all know I'm telling you the truth. It's a dog and pony show with this whole, asking these stupid questions. We don't need to hear these questions if it's going to tank the market. All right. The press conference is at 2:30. So it's supposed to be at 2:30. So now Eastern time, it's 2:07. So we got a half hour. I'm not going to let you guys go. I'm going to just hang here with y'all. We're going to talk for a minute. So I'm ready. I got my water right here. Thing full of water. I'm ready. I ran in here just to get to you guys. And hey, I'm ready. If it's going to have to be a telethon, so be it. 25.50. It went 25 basis points, just like I said, 25 basis points. It was baked in. Nobody is a genius by saying it was 25 basis points. That's what the Fed said, right? So I'm no genius. That's just what he says. You buying Tesla shares? Where is Tesla? As you can see, the Dow is actually trying to fight back now, right? Let's just see what the Fed does. Let's see. And here's one of the things I want you guys not to do. I don't want you to have tunnel vision with your trading. You guys just see me in the last 3 days, I got like 6 plays I shot to you guys. We made money on every single one of them. So what I want you guys to do is be diversified and don't have tunnel vision and just have your eye on one play. You're going to win some, you're going to lose some, but when you diversify, you'll win more than just having all of your money in one play. I'm telling you what's good. Hey, Tesla, look at this. Tesla's still, in spite of, Tesla's still up. Look at that. Tesla's still up. But look at that PE ratio now. 48, right? So you do you, I'm going to do me. All right. So I'm not telling you to buy, hold, or sell. Anything I say is not a suggestion for you to buy, hold, or sell. You got to do your own due diligence. But let me bring this up. We're at 109. Let me bring this up, good people, because this is important for you guys to see. All right. This is important for you guys to see. What 6 plays did he make money on? Man, look at the videos from yesterday and this morning and 2 days before and 3 days before. I've been giving you guys all of these hot plays, man. I talked about GM. I talked about LAC. I talked about GE Healthcare. I talked about Baidu. I talked about all of these plays. And we made money on all of them. All right. So just look at the videos before this one and then the ones that follow that. It's a trail. So please, guys, make sure you are getting. I can't do anything. And I know sometimes you guys don't get the notification. It's very frustrating because I want everybody to win. In my heart of hearts, I want everybody to win. Yep. And then Google. That's right. Google was another one. Yep. And so let me go here because I want you guys to see this. Let's look at this, good people. Look at this. Hedge funds boost treasury shorts to recover on rally doubt. You guys see this? You cannot turn a blind eye to this. Hedge funds are quietly building up the biggest bearish bet on bond futures on record. Read this. I want you guys to see this, right? And I know somebody going to say, man, you overly cautious, but you got to look at this. Hedge funds are quietly building up the biggest bearish bet on bond futures on record in aggregate measures, right? Net short non-commercial positions across all treasury manufacturers hit 2.4 million contracts, okay? So we getting mixed signals out there, right? We really are getting mixed signals. There's safety in bonds right now. It just is. There's safety in bonds, right? Some are betting that bonds will go down. Michael Saylor says sell everything. And then you got Kramer saying we're in a bull run. And you're getting all of these all over the place. You're just being yo-yoed and slingshot everywhere. So Larry, what do? I can't tell you what to do. I can only show you guys what I'm doing. I make money on the way down. I make money on the way up. I actually make more money in a bear season than I do a bull season. That you may not believe that, but that is the truth. Because I'm a momentum trader. I could see the momentum easier in a bear market, right? And so that's just why I made more money in 2008 on the way down than I actually did going up. So when I make my profits going down, what am I doing with the cash? You guys saw I was up 7,000 this morning. Yesterday I was up like 2,600, and you guys saw me do 12,000, 4,000. You guys seen me make tens of thousands of dollars doing these option plays. I'm just going to tell you what I do with that money. I got it in a bag in my trading portfolios. I'm cashed up. I'm ready. I'm locked. I'm loaded. So I don't have big money into anything. I actually took a little profits on Apple. And I know somebody might say, you never sell Apple. No, never say never. All right. I was in good profit. I still have Apple, but I took some profits. And I don't care if Apple runs up from here. Good for everybody else. I just know that if something does happen, which the 2-year and the 10-year yield curve is still inverted, if something does happen and we do have a bigger leg down, that's when I'm going to come on. I'm not going to waste any time saying I told you so. I'm not going to do that. But I'm going to say now it's time to buy, good people. Now it's time to move forward. Okay? It's time to charge. That's what I'm going to say. All right? So let's listen a bit, and then I'll come back to you guys.
Huge pay increases. So I don't see an awful lot of strength in wages. I think we could actually get by with a lower unemployment rate than it appears right now. So I don't think there's that much strength actually in the labor market. And meanwhile, as you say, there are plenty of indicators that things are slowing down. Now, and when you think about the May meeting, they're going to be looking back, I think, at a negative first quarter for real GDP growth at that May meeting. And that certainly should give them pause for thought.
Wow.
Cause to pause.
Yeah.
There's the phrase that pays.
Pause patrol. I think I've seen people talking about. Steve, quick final word then. Is the pause off the table?
For now, it is. They're definitely discussing it. I think that's the key. And I think Bob poses an interesting question we've been talking about all week. Does Powell?
So is the pause off the table? What they're talking about is the Fed pausing. So will he go up this 25 basis points he just said and pause? Or will he do another rate hike in March? I think he will do another 25 basis points in March. Now it's just a guess at this point, but I'm guessing that he will do another 25 basis points in March. That's what I do. So not Steve Leisman, the other gentleman that breaks the reports. I disagree with him. I don't think he's going to pause here. I think he's going to verbally, during his talk, he's going to verbally go a little hawkish. He's going to have to. And but I do believe that he's going to force the hand of a deeper recession. Not a recession, but a deeper recession, because we're in recession, right? And so that's what I believe. What do you guys believe? You said net gas being, yep, about Apple. And you may say that's coming real. My classes are coming really, really, really soon. So what about Apple? I tell you, like I said, I took a little profits on Apple because I was overweight Apple. I had a lot of Apple, right? So let's do this. Let's see. As we can see here, Apple is down by 1%. Not a lot, just down by 1.5%, as you guys could see. I'm sorry, 1%. And not much, okay? For the Dow to be down as much as it is, for the Dow to be down this much, that's not bad. But you guys do know that they're reporting on Thursday. So tomorrow they're reporting, and if it's negative, remember, you got some big, heavily weighted, especially heavily weighted on the S&P companies that's reporting on Thursday, right? And if they come out negative, that's going to be negative on the market. But if they come out positive, that may be good. But we also have to watch out for Friday's jobs, okay? Let's see if I can pull this up again. Come on. You could do it. There we go. Well, it's coming. There we go. All right. So we see here on Thursday, right? We got Amazon, Mammoth Company, Alphabet, which is Google, Mammoth, Apple, Mammoth companies, Qualcomm. These are huge. Qualcomm is in the chip area. These are huge companies, right? And let's see what the earnings is going to tell us. I'm not guessing it. I'm going to wait and see what the data is going to tell us, right? Trust the data. My chair is sinking. Keep sinking. All right, so we're going to trust the data is what we're going to do, right? And then I'm going to make my moves accordingly. And you go, hey, what happens if you miss the bottom? Man, I'm so sick of new people talking about missing the bottom, right? Anybody that has a crystal ball that could time the bottom for, somebody that's like, oh, you missed the bottom. Show me one person that could time the bottom, and that person needs to be the richest person in the universe, including Mars and Jupiter. Because that's all you can do is print money if you could time the bottom of the stock market, right? But it doesn't work that way. Wow, battery low already? Sorry, good people. I'm going to be here for a while, so I want to keep you guys. Let's listen to what they're talking about.
What the Fed did and what it said in its statement.
No great surprise for me. Everybody expected 25 basis points as the Fed is slowing down its tightening process. The big question is whether they're really done or not. If you look at the money supply, which is a very important variable that the Fed does not tend to look at, it's actually negative. So that is another indicator, in addition to the inverted yield curve, that the economy is slowing down and that we will be facing a recession in the middle of this year.
So that is your base case, is that there will be some sort of recession by mid-year. Does that then argue that the stock market has got it wrong? The market has been rising here for the past 3 or 4 months generally, and it had put in a very nice month of January. Do you expect that to cease if, as you just said, the telltales of recession become more evident?
Well, Tyler, we all agree the markets tend to be forward-looking. And in a forward-looking market, they may have priced in that small recession already. Mm-hmm. I'm not the great stock market guru that a lot of the other guests are, but I would see the stock market improving as a very positive sign that the recession will be relatively mild and not of a long duration.
What's going to happen to inflation, you think?
Inflation will continue to come down. And the reason for that is, again, that we see the money supply shrinking at the present time. It's going down, and that is still the best indicator for inflation. Half a year, year and a half in the future. So inflation will be more contained.
Talk to us a little bit, if you would, about the tightening of Fed policy with respect to its balance sheet and how important that is. Even after the Fed stops raising interest rates, presumably they will continue to reduce their balance sheet by selling into the market the securities that they own. That is another form of tightening, isn't it?
Exactly. And it's very important. But here you also bring then up implicitly the government policy. The Federal Reserve has financed the enormous increase in the federal deficits in the past. And that was, in my view, a mistake. But now we need the federal government to also tighten, to stop spending, to have a smaller deficits. And that will help monetary policy to achieve the goals that we all have. So the ball is really in the congressional and the administration realm. There we got to see the tightening and have good fiscal policy so that the debt doesn't continue to increase, which is now at more than 100% of GDP. These are levels at which Greece used to go broke.
It's no problem. We'll just hit the debt ceiling. It'll be fine. That's how we'll stop it. Serious question. What do you think is the lag with which monetary policy hits the economy? Because I often wonder when we're talking about the market pricing in this versus that, let's say the market sees 3 to 6 months out, but monetary policy is going to hit 12 to 18 months from now. Is there a mismatch there that the stock market can't quite see around the corner of what's coming? And didn't we see that where the biggest expansions in GDP were probably at the end of 2021, even though a lot of the stimulus hit in March of 2020, maybe January of 21? What's the lag that you think we should expect for all of the rate hikes that we're experiencing right now?
Well, that's a very tough question. Milton Friedman would answer, the lags are long and variable. And I think he was a very, very smart man. So monetary policy lags, I would say, are between 12 and 18 months in that ballpark.
12 to 18 months still. So you just wonder, can the market really see that far ahead? Maybe the bond market can, but I wonder about stocks.
Well, there are a lot of smart people in the stock market. There's money to be made. Whoever gets it right makes the most money. Yeah. So it's a self-correcting scheme in a way. Typically, I think the markets do not look that far ahead. They want to see sort of what is just in front of the windshield. Is it raining? People in the market will get a bit more depressed. But so you may well be right that the lags are different between the stock market and the monetary policy.
Governor Heller, it's always a privilege to talk to you. Thank you for joining us today.
Good to see you, Tyler.
You bet.
So you can pick a topic. Here we go. We got 6 minutes, as you guys can see. 6 minutes. Ha, ha. I tried to do the Dougie Fresh, but I couldn't. So we got 6 minutes. Some of y'all old heads know what I'm talking about. All right, so the Fed is going to be talking. Let me get this ready. Let's see where things are at. Let's see. Boom. Let's go here. Yep, we're still down. NASDAQ is pretty cool. But, a 300 point swing on an FOMC day is nothing. But let me warn you, depending on what he says, that could double. That negative 300 could be negative 600 just like that. Or it could be positive. The Dow could literally go green, literally while he's talking. You will see the Dow and all the other indices go on a roller coaster ride. Yep. Hey, thank you guys. Thank you guys. Thank you for that super chat. Hey, I'm working hard for y'all. Thank you so much, Villa. Thank you. Yeah, I'm with you, man. Let's rip this Band-Aid off. But I understand it's a balancing act. Yep. Yeah, you know what? I hope Jerome Powell don't talk long either, man. I just need him to just say, hey, here it is. Deuces. Drop the mic, walk off. Like, because they hitting you with these questions that is a setup. And, they like Beavis and Butthead. I said Butthead. Yep. They like Beavis and Butthead after they ask these questions. They're like, look at what I did to the market. And they don't realize that's you and our real hard-earned money, right? And so that's why between 2 and 2:30 on Fed Day is the most dangerous time to be trading. It is. It's the most dangerous time. That's why I was out of all of those positions you saw from my live from this morning. I cashed out on all of them. Actually, I cashed out on one, and the other ones, my stop loss hit. But my stop losses were where you saw it at. I set the stop losses because when I got off, they ran up a little higher. They came back, they triggered. I got my money. I'm out. No risk, right? And somebody will say, well, what if it runs up? This is not a table in Vegas, good people. It's not. Why some of y'all, a very small portion of y'all, why y'all trying to gamble? I'm showing you can make money without gambling. Limit your risk, limit your wins, but limit your losses. You will make money long term. It just works. I'm not new to this. I'm true to this. I made my first investment in 92. I've learned a lot. I've made a lot of mistakes. You learn from my mistakes. You learn from Mo's mistakes, Keenan's, stocks with Josh. Prosper. All right. All right. What else we got here? It's coming up. Let's see here. Let me blow it up. And just listen to some of these questions. Some of them will answer the same. One knucklehead will ask a question, and another knucklehead will ask the exact same question. And it just drives me crazy, causing the market to go down. Like, oh. We not trying to do that. We not trying to do that. Yeah, Baidu popped. We made that money. Yeah, Roy, right. It's only transitory. Right, Roy. I hear you, man. It's only transitory. Okay. Yeah, okay. What's up, Lucid? From Amsterdam? Somebody need to censor him. No chance of what happening? What chance of what happening? Right, get off the stage, Uncle P. I mean, it has to happen, all right? Okay, let's go into it. Let's just hear what they're saying leading up till, because a lot of times he's late. He's late entering. He'll walk up and do his thing. I wouldn't want his job. Somebody has to do it. I wouldn't want his job, though. Brazil. All right, let's hear what they're talking about.
The probability spectrum. If we really do have a really sharp downturn, no matter what the Fed says right now, they'll be cutting. But you don't find a lot of people coming on our air saying, I personally predict there will be 2 rate cuts in the second half of the year. It's much more about the market trying to price in the probability weighted outcome.
So let's talk a little bit about what could be an ongoing way of tightening the money supply.
Hey, y'all do me a favor and hit that like button. Could y'all do that for me right quick? Hit that like button, please. Let's get the likes up. All right, here we go.
Balance sheet since the spring. The S&P 500 is about at the level it was before that started. So I think they want that to be secondary and kind of just occurring in the background. I think more assertive forward guidance would be the first step, is basically try to call the market out and say we've revised our estimate for where we think rates have to stay for a long time.
All right, here comes Jay Powell. Thank you, Mike.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really In the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil. Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down. This is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation. And we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
Well, you'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're going to write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, you're right. If you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now. But that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. You know, it's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect.
They're having trouble with the live stream. It's not me, it's them. Come on. Come on. Load. Let's go. Come on. There we go.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and you know, my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think, you know, most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with you know, money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And you know, the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But, we have to deliver that. And so we are strongly resolved that we will, complete this task because we think it has benefits that will, support economic activity and benefit the public for many, many years.
Edwin. Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won because, we've got a long way to go. It's the early stages of disinflation. And it's most welcome to be able to say that we are now in disinflation, but that's great. But we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence? Or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, and we have inflation moving down. Into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we've kept that statement in there for for quite a while, and I think we knew we would take it out at some point. There's never a perfect time, but we thought that people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. I don't see that yet. But the whole point is, once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue. And once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are. We pick that up in conversations, and I've seen some data too that show people are, gradually they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses that essentially. We believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. In this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications. And I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Stocks are at session highs as the Fed chair wraps up his news conference. Big rally on those remarks. The Federal Reserve raises interest rates as expected by 1/4 percentage point. That's a step down from what we saw last time. The Fed chair talked a lot about the progress he is seeing on inflation. He used the word disinflation a number of times, potentially why the market is taking this as such a dovish read from the Federal Reserve chair. Look, he also said that they continue to see need for ongoing interest rate increases, that there's still more work to do when it comes to fighting inflation.
Well, you guys heard it. Everybody hit that like button. So he said some key things. He said, hey, can you guys hear me? I want to make sure you guys can hear me. Yes, you can. He said, hey, we expect a couple of more. Now, here's what I want you guys to be careful of. The market may not have heard when he said a couple of more rate hikes, right? So he could literally, talk about that later in the market react negative. But having said that, he sound very dovish, not hawkish. This is the most dovish I personally heard him sound in a while, which is really good. But we also know that the Fed Powell goes from hawkish to dovish and from dovish to hawkish. He's like, he's like that dude you used to date that was bipolar, or, or that girl, it's just needs some Xanax. And that's just what it is. So he could switch and on a dime. So you heard him talk about jobs. Jobs are still high. So unemployment is low, which is not a good sign for him. He wants that to come down to keep, inflation tamed. And then he talked about the housing market, right? The housing market is in trouble, actually. And it's good for buyers, bad for sellers. If you missed selling your house or your property, you're in trouble right now. Because right now, just like that, it turned into a buyer's market, okay? So I want to address something else, good people. So I know I have seasoned investors here, and I have new investors here, right? My Tesla put is in deep red. I'm never shorting Tesla. I'm just not doing that. I said that before. I'm just not shorting Tesla, right? Just not a good. It's just not a good idea, As we could see, let's see here. Tesla's up 8% after the Fed got through talking. Let's see where the indices are. Pretty flat, pretty good. I mean, the NASDAQ is on fire. Look at that, up almost 2%. The Dow is flat, and the S&P is up 1%. Now, you guys know how this goes. That does not even mean that the market will close at these rates. Even though we have like 40 minutes left, it doesn't mean that it's even going to close at this rate. Tomorrow is a big day. The next 2 days are big days. Tomorrow we have big tech reporting. Let's see. If big tech comes in with good reports, then we have a sustained bounce. That would be good news for the market, and it will be good news for all of us. Then if Friday comes and the job reports come out and say that there's higher unemployment, that's actually good for the market also. Sadly, people have to lose their jobs, but that is currently the Fed's job to cause jobs to be lost, right? So let me say one thing. The Maury family, bruh, listen, he's handling himself well. Yeah, he did. Fed handled himself very well. Actually, I thought he did well. So let me say this, right? Yeah, let me say this to those of you that are called expire. What? So let me say this. We don't know if it's Tesla, like Maury family. Maury, let me help your family. I'm looking at it, and you mentioned Tesla like 50 million times. I'm just saying this in love, bro. I want to help the family. Listen, never fall in love with a stock or whatever. And somebody might say, Larry missed this Tesla call. Yes, uncle, I give, whatever. But I can tell you, I still have more Tesla than you. So I'm winning either way it goes. I'm just trying to show you guys not to be monotone. Just a few days ago, when I can do a call like this on Tesla and be in and out in a day and make 48% in a day, it's called limiting risk. But I will tell you that this only scratches the surface on the calls that I did on Tesla. So I guarantee you I made more money with Tesla than you did. But I've been dollar cost averaging with my Tesla. It never stops. So did I miss this Tesla bounce? Yes. But go back and track Tesla and see the mood swings it has. So I'm going to tell you, and this is in no way braggadocious, I plan on having 6 figures in just Tesla alone. But I rather miss the bottom and err on the side of safety. So I'm a Tesla bull. I just didn't get in this bounce. But I'm not going to chase it now. I'm going to wait for it to come back, because guess what? Tesla does these mood swings just like crypto does. That's what it does. And so what I'm telling you guys that are new is don't just be mono-focused on one thing. One of my plays from last week, I showed you guys, I was up, 248%? 248%. So I'm trying to show you guys that there's over 4,000 stocks, okay? There's over 18 or 20,000 crypto. And so for people that's just Doge every day, or Shiba Inu every day, there is more money. For those of you that have been trading for a while, let's help the newbies understand that it's not one size fit all, right? I'm going to end by this. You can log off if you want to, but I want you guys that are older to listen to this. And this will help some of you that are younger. When I mean by that, I don't mean just in age, I mean in trading. In the 90s, in the 90s, I talked to an old investor, and we were about to write a contract, and he told me to wait until next week. Next week, I came and wrote a $14,000 contract. I was in sales. I said, "What are you doing?" He says, "I trade." And he said, "Young man, 1%. And I says, "What is 1%? He says, "That's how much I try to make every week." And I go, 1%? That's nothing. So he's older. He's retired. Gentleman, looks like the Dos Equis guy. He makes 1%. He goes in and he puts 50 G's in, right? And he makes 1% a week, right? Do the math. What's 1% of 50 grand? That's $5,000. So if he can make you know how easy it is for me to make 1%? So if he can make 1% a week, and there's weeks where he's done that 3 times, fam, he making 20K. So the more money you have, the less risky you have to be to make the same money. So my point is, in this trading market, it is not one size fit all, right? If you're younger, you can afford more risk, all right? So enough, all right? Enough. Uncle, you're right. I missed this Tesla bounce, but nobody, and I mean nobody, nobody hits 100% right. So for you to be following me as long as you have, and you got one, that means that I got you money on at least 25 other stock. So I want you, Maury family, to give me another 10 stock that you made money on listening instead of the one. This is winning every time is not investing. It's not gonna happen. All right. So, or else I'm gonna have to block you because I gotta feed the family, man. We got other plays. I keep bringing you guys stock that nobody else is talking about. I'm not just talking about Mullen. I'm not just talking about these hype stock that's going to put your money in danger. I am going to continue to be cautious in this bear market because I'm going to tell you what I still believe even after this, is that there is high risk of a major leg down still, but we're going to continue to make money and we're going to limit our risk. All right, good people? That's what I got to say to you guys. Yes, sir. Yes, sir. Yes, sir. Yeah, that's okay. That's okay. I'm going to have to get rid of them because we going to make money. And remember, it's never one size fit all. Maury family, I'm not like saying blah, 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 blah. I'm trying to help you because I want you to keep more money. So let me say this. In January of 2021, in December of 2021, I said, hey, I think we should be taking profits. Market is looking frothy. Everybody's like, no, you crazy, you crazy. Not everybody, a few people, and I could tell who the young ones is. You crazy, to the moon. We're in a bear market. We're in a bear market. And guess what happened all of 2022? Right? So I just erred on the side of caution. So what did that cause me to do? I have a bunch of cash. Guess what? Everybody that did not get into this Tesla bounce, what do you have? Cash, right? What is your risk? Zero. Never feel bad about having zero. So I'm telling you, as you could see, I still made a lot of money on Tesla. But what risk do I have right now in Tesla? Zero. Because I'm just simply dollar cost averaging like I've been doing all year long. So there's a lot of mature lessons to be learned in investing. So Tesla is really not a swing trade for me. It's not going to be a swing trade for me, though I swung it and made money. Tesla is going to be a long-term investment for me. I want to leave my grandkids some of Tesla. So I am not chasing the bottom. When it comes to Tesla, that PE scares the heck out of me. And I don't care if I take my pile of cash and go make money in 15 other stock rather than put all my risk into one basket. I'm going to keep telling you guys the truth no matter what happens. Yep. All right, good people. I'm going to leave it right there. Hey, don't forget. Yeah, y'all used to. I hear you, family. I hear you. Yep. Hey, I'll tell you, it always keeps coming back. It keeps coming back. You know, let me say another thing. You guys saw me in 2021. You guys saw me go bull. You guys saw me put 75K in a crap coin. And you guys saw me make 800%. And when everybody else was saying to the moon, this was all psychology trading. This was all momentum. And when everybody else was saying to the moon, to the moon, to the moon, I says, it's time to take profits, right? And then what happened? Oh, you're crazy, it's going to the moon. I locked in my profits and it kept running after that, but not by much, but it ran after that. But guess what? I made enough money to pay off my house and 2 cars. And so it's not one size fit all. So when I talk like this, it's not to get on anybody's case, but it's to learn lessons that's going to help make you money. So just remember, Maury family, it's not the price that you bought it, but it's the price that you're gonna sell it that's more important. All right. Yeah, it will. It just does. That's what Tesla does, you know. And shoot, I like Tesla, but I'm just going to keep you guys with the truth. Earth, Wind, and Fire. Earth, Wind, and Fire, and their. I love Earth, Wind, and Fire. How did you know? That's my favorite group. All right, I'm gonna leave it right there. Tesla future, yeah, Tesla future. But I'm going to tell you, there is some competition coming from Tesla, and not just GM and Ford. But I can tell you guys right now, you can say what you want to, but I don't have any stock in NIO, but that NIO is a better car than Tesla is. And not was the Xpeng. To me, that the nicest looking EV on the planet is that Xpeng. That for me, I like that car, but I have no stock in Xpeng. I have nothing, but I like that car. And trust me, there'll be other ones on the market, but I'll be honest with you, I don't see anybody giving Tesla a run until after 2026. So Tesla's going to be the top dog for a minute. So what am I going to do? I'm going to win with them all. I got some Ford, I got some GM, I got some Tesla. And when I see that they come down, then I'm in even more. GM, I'm buying a little more of that now than Ford, and then there's periods where I buy a little more Ford than GM. But that's the way I do, so I don't have all of my money in one basket. All right, good people? All right, we're going to leave it right there. This has been an hour and 36 minutes. All right, good people? Listen, I think I'll be on tonight with the guys over at Stocks with Josh's page. And I will probably try to pump another video out before then. I'm working for y'all today. So we're going to leave it at that. Make sure you check out the top link below. Moo has a brand new promotion. Download the app. They're going to ask some questions and make sure it's you. 1 penny gets you 12 free stock. All right? We'll talk again. Live, love, laugh, learn, and earn. And keep what you earn.